In the last lesson, we focused on how much risk to take. In this lesson, we're focusing on where that risk is actually placed in the global markets. Now that you understand your risk tolerance and asset allocation, the next step is deciding where you want your funds to be invested. When you buy an index fund, you are not just buying the stock market. You're choosing which countries, which industries, which company sizes, and how diversified you want your portfolio to be. This lesson will give you the clarity you need to make those decisions with confidence. When you invest in equities, you're buying ownership in companies around the world. The biggest decision here is, do you want a global portfolio or do you want to focus on specific regions? Let's break it down. A global index fund invests in thousands of companies all over the world, usually weighted by the size of each country's stock market. At the moment, the US makes up roughly 60% or more of the global stock market value. Japan is typically second. The UK sits around 3 to 4%. Emerging markets like India, China, Brazil, and so on fill the rest. With one fund, you're automatically diversified across regions, economies, currencies, and sectors. This is the simplest whole haystack approach. And for many beginners, it's more than enough. Some investors choose to focus more heavily on the United States because it has led the global stock market performance for decades. It is home to the world's largest and most innovative companies. Tech giant dominates: Microsoft, Apple, Nvidia, Amazon, Meta, Google. Even Warren Buffett famously recommends that general investors simply buy the US market. But over-concentrated in one country increases risk. Its past dominance does not guarantee future performance. A US portfolio can outperform or underperform the rest of the world. So it's a choice, not a default. Some people feel more comfortable investing in the UK because they recognize the brands they earn and spend in pounds. It feels more familiar. However, the UK stock market is very small globally. It is heavily weighted towards energy, financials, and consumer staples. It has underperformed the broader global market for many years. There's nothing wrong with adding UK exposure, particularly through a diversified global fund. But relying on the UK alone can significantly limit growth. Emerging markets include India, China, Brazil, South Africa, Indonesia, Mexico, and so on. These economies often grow faster than developed countries, but they also come with higher volatility, currency risk, regulatory uncertainty. Many global funds include a small allocation to emerging markets already. Some investors choose to add more, but this should be a conscious decision, not an automatic one. Geography isn't the only factor. Your portfolio is influenced by industries. For example, US-focused funds tend to be tech-heavy. UK-focused funds tend to be finance and energy-heavy. Emerging markets often overweight industrials and commodities. You can also invest in sector-specific ETFs such as technology, healthcare, clean energy, consumer goods, financials, real estate. But a clear warning: sectors can be powerful, but they're much riskier and more concentrated. You should only add them if you understand them and know why you want them. Most beginners simply rely on broad global diversification, which already spreads exposure across sectors. Another filter is company size. For example, large cap companies, big stable companies, which are lower risk and give slower growth. For example, Apple, Unilever, AstraZeneca. Mid-cap companies, which include middle-sized companies and has higher growth potential and moderate risk. Small-cap companies, very high growth potential and are much more volatile and often underrepresented in many global funds. Funds labeled All World or Global All Cap include companies of all sizes. Others, like the MSCI World, include only large and medium companies. Neither is right or wrong, but it's important to know what you're buying. Themes can include artificial intelligence, robotics, automation, clean energy or renewables, cybersecurity, hydrogen, genomics. These are exciting, fast-growing areas, but they are extremely concentrated and highly speculative. If you choose to invest in themes, treat them as a small satellite portion of your portfolio, not the core. A global index fund should almost always be the foundation. You don't need 20 funds. You don't need to chase the trends. You don't need to overcomplicate your portfolio. Most investors build around one of three simple structures. Core option 1. One fund portfolio. 100% global all-cap index fund. Maximum diversification, easy to maintain, simple and powerful, perfect for beginners. Core option 2. Market tilt. 80 to 90% global index fund. 10 to 20% additional exposure to preferred regions. US emerging markets. These ones are more tailored. Still diversified, moderate risk. Core option 3. Core plus satellite. 80% global index fund. 10% bonds, depending on risk tolerance. 10% sector or thematic funds. These are suitable for investors who already understand the basics and want limited experimentation. It gives room for exploration and still maintains diversification. Many investors get stuck because they feel they need the perfect mix, but in reality, simplicity beats complexity. Diversification beats speculation. Consistency beats timing. Staying invested beats chasing trends. Ask yourself, does this investment help me diversify? Do I understand it? Do I know why it belongs in my portfolio? If you can confidently answer those questions, you're on the right track. As always, this content is for educational purposes only and not financial advice. Your personal circumstances should always guide your investment decisions. You now understand the building blocks of a diversified global portfolio. In the next module, we'll move into the practical side. Module 5, choosing your broker and how to actually buy an index fund. We'll walk through Trading 212 and Invest Engine step by step so you can confidently make your investments. I'll see you in the next one.